Before we begin, I want to invite you to subscribe to this channel. We focus on thoughtful, disciplined financial insights, free from hype, free from sensationalism, and grounded in rational analysis. If you're serious about understanding markets and building genuine financial resilience, this is a space dedicated to that mission. Subscribe button in red. Thank you for being here. Let's continue. We're living through a fascinating moment in financial markets. For the last several years, most investors have become accustomed to a particular environment. They've watched technology stocks rise with unprecedented velocity. They've seen central banks flood the system with liquidity. They've experienced what many believed was an endless expansion in asset valuations. But conditions are shifting beneath the surface. The question facing investors right now isn't whether change is coming. It's whether they understand the nature of that change, and whether they're positioned to respond with discipline rather than panic. Silver, often overlooked, frequently misunderstood, sits at a critical intersection of this transformation. It's not a speculative asset class. It's not a get-rich-quick mechanism. Instead, it represents something more fundamental. A real asset with intrinsic utility embedded in the global economy, trading at levels that may not reflect the shifting macroeconomic environment ahead. This script is designed to help you think clearly about what that means. Whether you're already holding precious metals, contemplating your first position, or simply trying to understand the broader financial landscape, the framework we'll build together should serve as a foundation for rational decision-making. Let's start by establishing what's actually changing. Financial markets move in cycles. This isn't mystical. It's observable, repeatable, and grounded in human psychology and structural economic forces. For the past 15 years, the dominant cycle has been driven by extraordinary monetary expansion. When economies struggled, central banks responded with lower rates and asset purchases. When growth appeared to accelerate, they paused, but they never truly reversed course. This created a powerful dynamic. Investors learned that central banks would always support asset prices. That conditioning, that psychological anchor, shaped investment behavior. People bought equities not always because underlying fundamentals justified the valuations, but because the Fed put existed. The central bank would catch them if they fell. This wasn't irrational thinking within that environment. It was rational response to actual policy signals. But something changed in 2022 and 2023. Central banks finally raised interest rates. They began shrinking their balance sheets. The era of essentially unlimited monetary support began to contract, not expand. What happens when this reversal occurs? Historical precedent suggests that assets priced for a world of declining rates and monetary expansion become repriced for a world of higher rates and monetary contraction. This repricing isn't orderly, it's often painful, and it creates both risks and opportunities. Here's the critical insight. While most investors were focused on technology valuations and equity markets, something else was happening in commodities and precious metals. Silver, along with other real assets, had entered a long period of relative underperformance and depressed valuations. For years, investors had little interest in assets that don't produce cash flows, generate earnings, or fit neatly into traditional portfolio models. So they bought less of them, central banks added less of them, industrial demand remained subdued. But the actual structural demand for silver never disappeared. This is where we must separate hype from substance. Silver has remarkable industrial properties. It's the most electrically and thermally conductive metal known to man. It possesses antibacterial qualities. It's used extensively in solar panel production, electronics manufacturing, medical applications, and emerging technologies. When central banks expand money supplies aggressively, economic growth can appear strong on the surface, but inflation typically follows. When that inflation hits, governments and central banks eventually respond by tightening monetary policy. This contraction typically precedes economic slowdown. But here's the nuance. Inflation itself requires real goods. You can't print actual copper or silver out of thin air. And when inflation persists while economic growth slows, what economists call stagflation, certain real assets behave very differently than financial assets. History shows us this pattern. During the 1970s stagflation, stocks collapsed in real terms. Bonds were destroyed. But gold and silver, assets with intrinsic scarcity and industrial utility, provided protection and eventually significant returns. Are we in that environment now? Not entirely. But the structural setup contains elements that resemble it more than it has in decades. Here's what matters. Silver prices don't accurately reflect the industrial demand that's likely to accelerate if several macroeconomic scenarios unfold. The renewable energy transition alone, a structural shift that's moving from theoretical to implementation, requires vast quantities of silver for solar infrastructure. This isn't speculation, it's engineering reality. Let's examine investor sentiment directly. Right now, most individual investors aren't thinking about silver. They're not losing sleep over exposure to precious metals. In fact, many view precious metals as boring relics, assets their grandparents owned, belonging to a bygone era. This perception is significant. In financial markets, when the majority holds a certain belief, and that belief is emotionally comfortable, prices often don't reflect underlying reality. Instead, prices reflect the current consensus. When consensus finally shifts, and it always does, the repricing can be swift and significant. Consider this. When was the last time you heard a financial advisor enthusiastically recommend precious metals to their clients? For most investors, it's been years. The dominant narrative has been technology, growth equities, cryptocurrencies, anything but unproductive assets like silver. Yet here we are with manufacturing capacity for silver constrained globally, industrial demand rising, particularly in energy transition sectors, central bank policies beginning to shift away from unlimited monetary expansion, geopolitical fragmentation, raising risks to global supply chains, a complete absence of speculative fever in precious metals markets. This is precisely the type of environment where contrarian positioning becomes valuable. But here's where discipline matters. Being contrarian isn't the same as being right, and being early in a trend can feel like being wrong for an extended period. The key to navigating contrarian positions successfully is having both conviction in the underlying thesis and emotional discipline to maintain your position when the prevailing sentiment dismisses you. The advice for someone already holding silver differs meaningfully from the advice for someone considering an initial position. Let's address both clearly. If you currently own silver, whether physical metal, mining stocks, or exposure through ETFs, your primary obligation is to yourself. Maintain emotional discipline. Now, the worst time to evaluate your position is when it's down, or when everyone around you is suggesting that precious metals are irrelevant. These are typically the moments when you most feel pressure to sell. Instead, establish clear criteria for your position beforehand. Why did you acquire it? What macroeconomic conditions would need to change for your thesis to be invalid? What percentage of your portfolio should it represent? These questions should be answered before volatility tests your conviction. For most existing holders, the advice is simple. Review your allocation. If silver represents 3 to 5% of your total investable assets, you likely have enough exposure to benefit from any meaningful shift in monetary conditions without overconcentrating your portfolio. If you have significantly more, consider whether that matches your risk tolerance and time horizon. Most importantly, do not increase your position based on enthusiasm or fear. If you believe the structural case for silver is sound, then small, regular additions over time, dollar cost averaging, will serve you better than concentrating larger purchases during periods of emotional conviction. Your advantage as an existing holder is time. You've already made the decision. The psychological battle for you is to avoid reversing it at the wrong moment. If you're considering your first meaningful position in silver, the framework is different. First, understand that this is a multi-year thesis. If you're hoping to double your money in 6 months, you've misunderstood both the asset class and the time frame we're discussing. The shift in monetary conditions and macroeconomic positioning that would drive significant silver appreciation takes years to unfold, not quarters. Second, determine the appropriate position size. For most portfolios, 2 to 5% in precious metals provides meaningful diversification benefit without excessive concentration risk. This might mean $5,000 for someone with a $200,000 portfolio, or $25,000 for someone with a $1 million portfolio. Third, understand the different vehicles available to you. Physical silver, coins, and bars stored securely provides the ultimate hedge against systemic risk. You own the metal directly. No counterparty can fail and leave you without your asset. But physical silver requires storage, insurance, and carries transaction costs. It's illiquid. Selling takes time. Silver mining stocks provide leverage to silver prices. If silver appreciates 50%, quality silver mining stocks might appreciate 150%, but they also carry business and operational risks that pure metal exposure doesn't. A mining company can be mismanaged or face unexpected costs that reduce shareholder value even if silver prices rise. Silver ETFs and mutual funds offer convenient exposure. They're liquid, easy to buy and sell, and require no physical storage. But they involve counterparty risk: the fund manager, the custodian, the fund administrator. In extreme scenarios, fund structures can break down. The wisest approach for most investors is a diversified combination. Perhaps 50% physical silver in a secure location, 30% through a trusted silver ETF, and 20% in a position in quality silver mining stocks. This balances the security of physical ownership with the convenience and leverage of financial instruments. But this is personalized to your situation. Someone living in a stable, developed country with excellent property rights might weight toward physical ownership. Someone with limited capital and long time horizon might focus on mining stocks for leverage. Someone wanting simplicity might use only ETFs. the vehicle matters less than the decision to take a position aligned with your conviction and circumstances. Let's examine the broader economic environment that makes this timing significant. Global debt levels have reached unprecedented heights. Governments, corporations, and individuals collectively owe more money than at any point in history, measured both in absolute terms and relative to economic output. When debt reaches such levels, only a few options exist. The debt must be repaid through genuine economic growth and fiscal discipline. This is possible, but historically rare. Interest rates must be kept extremely low, effectively subsidizing borrowers and reducing the real burden of debt. This transfers wealth from savers to borrowers and creates its own distortions. The debt must be inflated away. The currency slowly loses purchasing power, making old debts easier to pay with future depreciated dollars. There must be a default or restructuring event where creditors accept less than they're owed. Given the political difficulty of option 1, the current policy consensus globally has been some combination of options 2 and 3. This strategy requires maintaining low rates and accepting higher inflation as a price of sustainability. But here's where the shift becomes critical. Inflation cannot coexist indefinitely with near zero interest rates. At some point, either rates must rise to fight inflation, or inflation must be acknowledged and accepted as permanent. The world chose to raise rates in 2022 and 2023. This had immediate consequences. Fixed income securities, bonds that had paid 2% for years, suddenly offered 5% or higher. This repriced them downward for current holders. Real estate markets, which depend on low financing costs, began to cool. Technology stocks, valued based on distant future cash flows, became less attractive when discount rates rose. But these financial repricing effects create a second effect. Actual economic activity slows. When borrowing becomes expensive, businesses invest less. Consumers spend less. Employment eventually softens. This creates pressure to ease monetary policy again, setting up a cycle of tightening and loosening that characterizes monetary management in highly indebted environments. Silver benefits from this cycle in specific ways. If inflation persists and rates stay elevated, silver, a real asset with intrinsic value, protects purchasing power better than cash or bonds. If a recession develops and rates eventually decline again, the monetary expansion required to ease conditions will eventually drive new inflation, again benefiting real assets. If geopolitical tensions escalate, safe haven demand typically benefits precious metals. If the energy transition accelerates, industrial demand for silver rises structurally. In nearly all plausible scenarios ahead, silver's value proposition improves relative to the last decade. Examining past periods when silver appreciated significantly reveals patterns worth understanding. The 1970s and early 1980s saw dramatic silver appreciation. Silver rose from $1.50 per ounce in 1970 to nearly $50 in 1980. What created this environment? Persistent inflation from monetary expansion in the late 1960s and 1970s, geopolitical instability and energy shocks. A currency, the US dollar, that was depreciating as investors lost confidence in fixed exchange rates. Gold and silver became the ultimate hedge against currency debasement. Yet here's the crucial point. The appreciation took years to develop. It wasn't linear. There were significant drawdowns. Investors who bought at $1.50 and sold at $5 saw what seemed like massive gains, but held too little conviction. Those who held through the entire cycle captured the extraordinary gains. More recently, from 2001 to 2011, silver appreciated from roughly $4 to $50 per ounce. This followed the housing bubble, a major financial crisis, and subsequent massive monetary expansion. Investors who recognized the structural forces at work early had years to accumulate positions before recognition became widespread. What's instructive from both periods? First, the catalysts were already visible years before major appreciation occurred. A keen observer in 2000 could see that monetary expansion was beginning and asset prices were becoming detached from fundamentals. An observer in 2020 could see that central banks were embarking on unprecedented expansion. Second, the people who benefited most weren't those making rapid trading decisions. They were those who recognized the thesis, took a position sized appropriately for their circumstances, and maintained discipline through volatility. Third, the most profitable periods often feel uncomfortable. And while silver was rising from 2001 to 2011, most investors dismissed it as a bubble driven by speculators. The dominant sentiment throughout that period was skepticism. Comfort never arrived until after the majority had capitulated and capitalization had largely occurred. This is the psychological test you must prepare for now. This section is perhaps the most important. Understanding what not to do often matters more than understanding what to do. Silver, like all commodities, experiences meaningful price swings. A 10% move in a few weeks is completely normal. A 20% move in a few months is not unusual. If you enter a silver position and then spend the next 12 months checking prices daily, you will experience emotional distress. The constant noise of small price movements will create a false sense of urgency about your position. The solution is simple. Establish your position, then check it quarterly, not daily. If your time horizon is several years, daily prices are irrelevant to your decision making. Worse than simple nervousness is the tendency to make trading decisions based on short-term movements. You buy silver at $22 per ounce, convinced of the thesis. 3 months later, it drops to $20. You panic and sell, locking in a loss. Then, 3 years later, silver rises to $45. Your panic sale was the most expensive mistake you made. Avoid this through discipline. Before you buy, establish clear price points or conditions that would make you wrong. If silver were to fall to $15, perhaps your thesis would be invalidated. If silver were to decline while industrial demand surged, perhaps you're misunderstanding the market. But random 10% moves in either direction shouldn't trigger action. Leverage, using borrowed money to amplify your position, is catastrophically destructive to most investors. You might read about someone who doubled their money by using leverage in silver and think this is a model to follow. What you typically don't read about is that for every success story with leverage, there are 10 stories of people who used leverage and got liquidated when prices moved against them. Here's the mechanical reality. If you buy $10,000 of silver at $22 per ounce, you own roughly 450 ounces. If silver drops to $20, you've lost $900 or 9%. You can sleep at night. You can maintain your thesis. But if you borrowed $40,000 to buy $50,000 of silver and it drops to $20, you've lost $10,000 or 25% of your capital. You're likely facing margin calls. Your broker might force you to sell. You're no longer making rational decisions. You're in survival mode. This is why almost all successful long-term investors in precious metals own them without leverage. They buy what they can afford. They hold for years. You should do the same. Silver should represent a portion of a diversified portfolio, not your entire portfolio. A reasonable approach might be 40% diversified equities, and 20% bonds or fixed income, 15% real estate or real estate exposure, 10% precious metals, including silver, 10% cash and alternatives, 5% other alternatives. This provides meaningful precious metals exposure without concentration risk. If silver were to collapse for reasons you didn't anticipate, your entire financial security isn't destroyed. Conversely, if someone tells you that precious metals should be 80% of your portfolio, they're giving you dangerous advice. The allure of extreme positions is seductive, the potential for massive returns, but the probability of catastrophic loss is equally elevated. Avoid concentration. It's not sophisticated, it's risky. The worst time to buy any asset is after everyone's talking about it and everyone's made money. If silver reaches $50 per ounce and it's on the front page of every financial publication and your barber is telling you to buy it, the potential return has likely already been captured. You're buying into momentum, not thesis. The right time to build positions is when nobody's interested. It's uncomfortable, it feels wrong, it should. If it felt good and exciting, you'd be late. A discipline here. Write down the price at which you plan to begin accumulating. Perhaps it's $20 per ounce. Perhaps it's $18. But decide this rationally, not emotionally, and then gradually add to your position at your target prices, not at whatever the current price happens to be. This is subtle but critical. While you're holding silver, that capital isn't working elsewhere. If you'd invested in a diversified business or real estate or dividend-paying equities, that capital might be generating returns. This means silver isn't appropriate for 100% of a portfolio, and it means you should have a realistic expectation of timing. If your thesis is that silver will meaningfully appreciate in the next 3 to 5 years, that's reasonable. If you're holding silver waiting for something to happen on an infinite timeline with no specific catalysts identified, you're essentially gambling. You need to understand, specifically, what economic conditions or events would cause silver to appreciate, and you need to have a reasonable timeline for those conditions to develop. Finally, the mistake of investing in silver without understanding why you're doing it. You should be able to articulate in clear terms the thesis for silver. It might be, I believe persistent inflation will erode the real returns of bonds and cash. Silver is a real asset that will preserve purchasing power in an inflationary environment. Or, I believe the energy transition will create structural demand for silver that will exceed supply. This will drive prices meaningfully higher over the next 5-10 years. Or, I believe geopolitical fragmentation and central bank policy shifts create conditions similar to the 1970s, when precious metals provided essential hedges. Whatever your thesis is, you should be able to state it clearly. Because when you face inevitable periods of doubt, and you will, you need to return to your fundamental reasoning, not to your emotions. If you can't articulate why you own silver, you shouldn't own it. Understanding risk means accepting that your thesis could be wrong. What are the realistic downside scenarios for silver? Technology solutions might reduce industrial silver demand. Battery technology, for instance, might advance in ways that reduce solar reliance, reducing industrial demand for silver. Deflation, rather than inflation, might develop. If the global economy enters a deflationary spiral, prices falling, demand collapsing, precious metals provide poor protection because their absolute prices fall too. A major supply discovery might occur. Large new silver reserves could be identified and developed, increasing supply and reducing prices. Economic growth might accelerate without inflation, eliminating the case for precious metals hedging. Your task isn't to eliminate all risk, it's to understand it clearly and size your position appropriately to withstand scenarios where you're wrong. If you've sized silver at 5% of your portfolio and your thesis is invalidated, you've lost 5% of your portfolio. That's manageable. You can learn and adjust. If you've sized it at 60% and you're wrong, you're facing a financial crisis. This is why position sizing matters more than being right. Let's synthesize this into a practical framework. Write down, specifically, why you believe silver valuations may shift favorably. What economic conditions are you anticipating? Over what time frame? What would need to happen for you to be wrong? This doesn't need to be elaborate, but it should be clear enough that you can reference it during periods of volatility. Based on your total portfolio, your time horizon, and your risk tolerance, establish what percentage of your portfolio should be in precious metals. For most investors, 3 to 8% is appropriate. For extremely risk-averse investors, 1 to 3% is appropriate. For speculators with substantial capital and high risk tolerance, 10-15% might be acceptable. Do not exceed these ranges based on conviction. Conviction doesn't protect against black swan events. Decide whether you want physical silver, mining stocks, ETFs, or a combination. There's no single correct answer. The correct answer is the one that aligns with your circumstances, risk tolerance, and access to secure storage if choosing physical. Decide the price levels at which you're willing to accumulate. If you believe silver is fairly valued at $22 to $25 per ounce currently, perhaps you'll accumulate up to those prices. Perhaps you'll wait for $20. The point is to decide this rationally, not reactively. Establish how frequently you'll review your position. Quarterly is appropriate. More frequently invites emotional decision-making. Less frequently means you might miss critical warnings that your thesis is invalidated. When you review, assess, has my thesis changed? Is my position still appropriately sized? Do macroeconomic conditions still support my original thinking? This isn't checking prices obsessively. It's disciplined, infrequent reassessment. Before volatility arrives, anticipate it. Tell yourself, silver will likely drop 15-20% at some point during my holding period. This will test my conviction. But if my thesis hasn't changed, this is an opportunity to accumulate more, not a sign to panic. When volatility arrives, and it will, you'll be psychologically prepared rather than shocked. This is the hardest step. It's the difference between investors who succeed and investors who merely participate. As we approach a conclusion, let's examine broader signals that reinforce the silver thesis. Central banks globally have stopped reducing their balance sheets. The Federal Reserve signaled in 2023 that unlimited monetary expansion was over, but the market continues to price in rate cuts. This suggests expectations of economic weakness ahead. When central banks eventually lower rates again, likely in 2024 or 2025, the monetary expansion that follows will create pressure on currencies and purchasing power. This benefits precious metals. Meanwhile, actual physical demand for silver continues to grow. Solar manufacturers, electronics manufacturers, and industrial users need silver. This demand doesn't disappear during corrections. Supply, however, is becoming constrained. New silver mines take years to develop and require significant capital investment, which has been lacking for years. The Energy Information Administration estimates that renewable energy deployment will nearly double in the next 5 years globally. This alone requires more silver annually than has historically been demanded. Whether the market has priced this structural demand shift is highly questionable. Geopolitically, fragmentation continues. The Western alliance is less cohesive than it was a decade ago. China and Russia are increasingly independent. This fragmentation threatens global supply chains. Silver, a critical commodity with concentrated production, becomes strategically important. Central banks, recognizing this, have been quietly accumulating reserve assets. The ones with the lowest profile and most strategic importance? Precious metals. These aren't speculative signals. These are observable macroeconomic and geopolitical realities that the financial markets seem to be underpricing in terms of precious metals valuations. Here's what separates a true opportunity from mere hope. A true opportunity exhibits these characteristics. The return potential is substantial enough to justify the position despite real risks. Silver isn't going to return 500%, but a doubling or tripling of value over several years would constitute meaningful returns. The underlying fundamentals support the thesis independent of price movements. Silver is actually needed industrially. Production actually is constrained. Central banks actually are shifting policy. These facts don't depend on silver's price rising. The majority market sentiment is skeptical or indifferent. Nobody's rushing into silver right now. The dominant narrative around hard assets remains deeply skeptical. The position sizing is conservative enough to be sustainable through inevitable volatility. You're not betting your financial future on this thesis. The time frame is long enough that catalysts have time to develop and market recognition has time to occur. This isn't a 3-month bet. Silver exhibits all of these characteristics currently. This is why examining silver isn't reckless speculation. It's prudent diversification aligned with probable macroeconomic scenarios. Perhaps the most underrated investment quality is patience. Markets reward those willing to wait for conditions to develop. An investor who recognized in 2001 that monetary expansion and currency debasement were likely had an extraordinary opportunity ahead, but only if he remained patient through a decade of skepticism. Patience is harder than it sounds because it requires comfort with being wrong in the short term while maintaining conviction about the long term. You might buy silver at $23 per ounce. For the next 12 months, it trades between $19 and $24. It doesn't feel like a brilliant investment. You're not seeing the returns you anticipated. Your friends who bought technology stocks are doing better. Your conviction is tested. But patience means holding your position despite these circumstances. Then, in year 2, economic conditions shift. Interest rates begin declining. Inflation accelerates. Central banks resume monetary expansion. Silver rises to $35. Suddenly, the choice to remain patient looks brilliant. This is the typical pattern with asymmetric opportunities. Long periods of unremarkable performance, followed by concentrated periods where thesis validation occurs and returns accelerate. The investors who succeed are those willing to go through the unremarkable periods to reach the thesis validation phase. Can you be that investor? Only you can answer. But if you can remain patient and disciplined, silver positioning may prove to be one of the most valuable decisions you make over the next several years. It's not about becoming wealthy. It's about resilience. As we've examined, the global financial system faces genuine structural challenges. Debt levels are unsustainable under current economic growth rates. Monetary policy has constrained options. Political fragmentation is increasing. The energy system is undergoing dramatic transformation. These are complex, multifaceted challenges without simple solutions. In this environment, the wisest investor isn't the one attempting to predict exactly which asset will rise first. It's the investor who builds a diversified portfolio with multiple hedges against different scenarios. Real estate provides inflation hedging and income. Equities provide ownership of productive enterprises. Bonds provide stability. Cash provides optionality. And precious metals, particularly silver with its dual nature as both a monetary asset and an industrial commodity, provide insurance and diversification. The conversation we've had here is fundamentally about this insurance. You're not investing in silver hoping to become a millionaire. You're positioning in silver recognizing that the next 5 years will likely differ dramatically from the last 5 years, and that real assets protect purchasing power and provide optionality when financial conditions shift. This is a mature, sophisticated approach to wealth preservation. It requires discipline. It requires emotional control. It requires patience. But it produces results that purely financial assets, stocks and bonds exposed to the same central bank policy shifts, cannot independently produce. If you're convinced by the thesis we've outlined here, what should you do immediately? First, stop. Don't rush. Establish your framework as outlined earlier. An angel. Second, research the specific vehicle that makes sense for you. If you're drawn to physical silver, identify a reputable dealer. Research their pricing and reliability. If you're interested in ETFs, examine the available options and their structure. If mining stocks appeal to you, study several companies and their fundamentals. Third, if your thesis is solid, begin accumulating at planned price levels over time. Dollar cost averaging, buying regular amounts regardless of price fluctuations, is significantly more effective than attempting to time a single large purchase. Fourth, establish your monitoring protocol. Decide when you'll review. Decide what conditions would change your thesis. Decide how you'll maintain discipline. Fifth, build your broader portfolio around this silver position. Remember, 5% of a well-constructed portfolio is meaningful positioning. It's not the entirety of your strategy. Finally, trust the process. The most valuable investments are often the most uncomfortable in the short term. If your position feels uncomfortable because everyone around you is skeptical, that's probably confirmation that you're in an asymmetric opportunity, not that you've made a mistake. In closing, let's return to something fundamental. You're living through a specific moment in financial history. Debt is at unprecedented levels. Monetary policy has reached the limits of its effectiveness. Geopolitical fragmentation is increasing, The energy system is undergoing transformation. In this environment, those investors who've diversified beyond traditional equity and bond portfolios, particularly those who've included real assets like silver, are building resilience that others are not. This isn't about timing. It's not about outsmarting the market. It's about recognizing that the next 5 years will likely differ from the last 5 years, and that simple prudence suggests positioning in assets that have historically performed well during periods of monetary uncertainty and policy shifts. Silver is one such asset. Its dual nature, both an industrial commodity and a store of value, makes it uniquely suited to uncertain times. The opportunity to position in silver at current valuations, with skepticism from the majority of investors, is precisely the kind of opportunity that creates long-term wealth. You have the framework, you have the analysis, you understand both the opportunity and the risks. The decision of whether to act is yours and yours alone. Whatever you decide, decide consciously. Decide based on clarity and thesis, not emotion and hype. That is the essence of disciplined investing. Thank you for your time and attention. Whatever path you choose, I trust it will be one grounded in careful thought and rational analysis. We'll see you in the next analysis.